You know, Don Luskin, let me go to you because there's a lot of political change in the air that hints at a return to free market capitalism. The tax cuts, the meetings with the CEO, the South Korean free trade deal. I want to ask you, are these just atmospherics or are they filtering into the stock market for potentially new pro-growth policies?
No, they are filtering into the stock market, and they actually have been since July. Remember, this started in July, where this whole movement to extend the dreaded, loathed Bush tax cuts began in the Senate with 4 Democrats stepping forward and saying they wanted to do it. It was no one was holding a gun to their head. Not one of the 4 was up for re-election. They did it because they have started to get a message from the American public, which is simply this: there is no problem in the world that cannot be solved if you let someone get rich doing it.
All right.
That's the way we're going to start doing stuff in this country again.
Dave Goldman, another one is there's a lot of rumors that President Obama might be looking at some flat tax reform, both the personal code and the corporate code. And in fact, he might borrow some spending reductions from the Erskine-Bowles-Allen Simpson Commission. This, too, it seems to me, is bullish for growth in the stock market. Is it just atmospherics, or is there something to this, Mr. Goldman?
There's something definitely to it, Larry. Gerald Sieb's report in the Wall Street Journal today saying that this might be the thin end of a wedge for a flat tax was probably the single most encouraging report I've seen in a while. But there are still enormous ifs attached to this in a deadlocked Congress. I think we've got, at the moment, a modest rally with a lot to be modest about, with the possibility of some major openings. One major positive I would add to that is the fact that China didn't raise interest rates. China's not having a bubble. It's not having a crippling inflationary problem. That economic machine is cranking away, and that was a big contributor to the rally in the U.S. in the last several days. 2 words of caution. One is the U.S. consumer still has saved 1/10 of what he needs to retire, according to Wells Fargo, and his home equity is still deteriorating. Secondly, we have our own equivalent of the Southern European debt crisis in American cities, which are only now beginning to feel the effect of collapsing real estate values on their tax revenues. Much more worried about cities than states, with the exception of California and Illinois, who I think will probably be bankrupt. So,
but don't
major
forget New York,
bumps.
for heaven's sakes. You must not forget New York. If you're going to go down that road, you must not forget New York. I mean, New York is a disaster.
New York City's a disaster. New York State, I think, is going to come out okay. It's much more of a city than a state crisis. But remember, the cities have 70% of all state and local employees, and they deal with the big unions. So the political confrontation is going to come there. So I see a balanced picture now with the stock market racking up modest gains day by day, which could break out in either direction. Either we have a financial crisis due to the city-state issue, or we have a breakout in the tax side. If Obama is smart and not ideological, he'll go that way.
I got to get to Keith McCullough. Keith, I want to ask you now, you've got blowout retail sales today, 5 straight months, I think a growth rate of 12% at an annual rate. So that's good for the consumer. You have these positive political developments, maybe some kind of return toward, I say toward, capitalism and freedom again. And finally, Keith, the Fed is providing the vigorish for all this. The Fed is greasing the wheels of commerce, and that too plays a role. Do we need the Fed? Do we have deflation? Do we have recession? What's your take on this?
Well, we definitely don't have deflation. We have massive amounts of inflation, certainly if you look at it on a trend basis. And what matters to people is what's happening in terms of prices right here and now. I think Ben Bernanke is very much out of touch with what prices are doing in the real market. And today, he just gave you a revisionist message, effectively, as to what, what's already occurred. But when you look forward...
What was his revision? Let me ask you, because I read the statement, it sounded like nothing has changed. He's just bound to determine he's going to go through with QE2. He's going to put $600 billion of newly bought bonds and cash. Was there anything new in your judgment in the Fed statement today?
No, he continues to basically talk about price stability when I see the absolute opposite in commodity markets, stock markets, and volatility itself. He's effectively sponsoring volatility, and I think, talking about the free market idea, I mean, big government intervention, whether it's from the Fed or from Congress, is not my idea of free markets. So I think that that's a big scary factor that's in the market that's creating, a scare in the bond market in particular. Yields are pushing higher as inflation does.
All right, well, I'm just making the case that President Obama is moving from Reverend Right, at least in the direction of Bill Clinton. Milton Friedman might be out there someplace. But Don Luskin, Keith makes some biting criticism criticisms of the Fed, higher long-term interest rates, the threat of inflation. What do you make of that? Is the Fed's greasing the wheels of commerce good or bad for the stock market and this whole new capitalism story?
Well, it's self-evidently good. The stock market bottomed and has had a spectacular rally since mid-year when Ben Bernanke started hinting about QE2. You know, what do you think? These 5 months you're talking about when we've had these fantastic back-to-back retail sales blowouts, that's all been since QE2 started getting talked about. The backup in bond yields, that's further proof that it's working. So that means inflation expectations are getting a little healthier. It means growth expectations are getting a little healthier. Folks, this is what success looks like. And look, I know that we libertarians, we small government people, find it loathsome when the central bank says it's going to do anything to the tune of $600 billion. That's a lot of $1 billion, and I don't like that. However, the way to get a central bank to be non-interventionist doesn't have to do with the amount of their balance sheet. It has to do with getting them to not be too tight and to not be too loose. The Fed was too tight. This action makes them more toward just perfect in the middle, and that's the least interventionist thing they could do. And that's why stocks have had, what, almost a 20% rally since mid-year. Give me a break.
How does a 0% interest rate make the Fed too tight? I think the other
the reason why, Keith, is you have to go back to Milton Friedman, the greatest monetary economist of our lifetimes, who said you cannot tell whether a central bank is too loose or too tight based on simply looking at its interest rate. You have to look at all of the economic conditions in which that interest rate exists. So what are those economic conditions? We have persistent high long-term unemployment. We have weirdly low inflation. We have no borrowing. We have no lending. We have slow growth. Oh my God, it looks exactly like an economy looks when there is a Fed that is too tight.
We're also borrowing $1 trillion from overseas central banks as of September.
I'm sorry, why does that matter?
And because...
What does that have to do with monetary policy?
Because the major reason for the backup in yields since the Federal Reserve announced QE2 is a buyer's strike on the part of our foreign funders. It has nothing to do with inflation expectations.
You have no evidence of that. How do you know there's been a buyer's strike by foreign funders?
Mark my words, when the tick data come out for October and November,
okay, so this is a prediction. This is your prediction.
There's been zero change in inflation expectations. There has been
But TIPS break-even spreads have widened out.
Don,
how can you say there's been none?
Don, the Fed is effectively buying more bonds than God could, and bond yields are still breaking out. How do you say where is the evidence of bond yields? Bond yields are breaking out to the upside, and it's a global factor. And to say that global prices aren't going up is beyond reckless at this point.
This is the closed economy fishbowl way of looking at things, which was Milton Friedman's critical flaw, as Robert Mundell used to point out. The Fed's purchases are much lower than foreign central banks' purchases, which are running at $1 trillion rate.
I thought they were bigger than God.
We're not going to sell this. I don't want to get too deep into the woods. I just want to ask Keith. Keith, a friend of mine said money managers, particularly mutual funds, missed the 2010 rally, okay? The generals always fight the last war, and they're gearing up to win the 2011 rally. Is it possible, Keith, is it possible that this could give us a new record high in the stock market next year? We're still below the 2007 high, but I want to ask you, if all these mutual funds and other money managers, not the hedgies, because we don't know what they've done, but all these other mutual fund managers, if they come piling in because they missed 2010 and they want to get on the caravan in 2011, could that get us to new highs, Keith? You get the last word tonight.
No, I absolutely do not think so. And a lot of the things that Don's effectively talking about were things that he was talking about in 2008. The world's awash with liquidity. Don't worry about interconnected risk. Don't worry about $150 oil. In this case, you don't have to worry about...
Did I just say any of that?
3 billion of the world's people,
did I just say any of that?
Focusing on rice prices being at all-time highs.
Keith,
I mean,
that's
all
not
these things
fair. I didn't say any of that.
Effectively, Larry, lead to growth slowing because inflation slows growth
we have a
as
difference
countries
of opinion. I
raise
appreciate
interest rates.
that. All I'm trying to say is a movement in the direction of capitalism and freedom has to be good, but we will continue the monetary debate. Keith